So let's see if I manage to actually recognize everyone now with your pictures on. So let's start. Yes, please have a seat. Have a seat, please. So let me start, and let me just make sure that we have Christophe Borde. Christophe Borde, you're Managing Director, Infra Capital, and former board member of Recharge, the leading fasting charging in Scandinavia for more than 4 years. We also have Laurent Fortune, you're CEO of Kevin Speed, which is the first railway company allowing to share the existing high-speed tracks of SNCF Réseau. You were previously head of capital projects at RATP, as we say RATP here in France, our metro buses company here in Paris, and also CEO of Eurotunnel. Then I move on to this side, Rodolfo Guarino. You are CEO and founder of Hippocrates Holding. It's actually Italy's largest network of pharmacies. The company was acquired by Entin in February 2021 and has since more than tripled its size from 150 up to more than 500 pharmacies. Congratulations to you. And then on your left-hand side, Ben Wright, your Chief Financial Officer at Statera Energy, the UK-based market leader in energy storage and flexibility, balancing the low-carbon renewable power grid. And the company was acquired by EQT in January 24 with ambitious plans, as ambitious, even more, I would say, as your neighbor, to develop over than 7.5 gigawatts of assets by 2030. All the best then. And let me introduce you also, our great moderators, Philippe Bory, your senior banker and global head of transports and environment industry group. We also have Julien Deveau, regional head of infrastructure and energy finance for the United Kingdoms and also the Nordics, for both from Natixis CIB. And I'll start with you, Philippe, to tell us more about the purpose of this panel. Thank you.
Thank you. Yeah, the infra world is changing, clearly. Technological changes, market liberalization, evolution of the risk appetite of the infra world investors. All this fostered the apparition of new asset class with new type of risks, such as the AV charging business, the battery storage business, new high-speed train operators. All these are just examples. All these segments are quite far from the usual, I would say, regulated or contracted market in which we used to the, I would say, the infra world.
Thank you, Philippe. Indeed, in this context, sponsors have to find suitable pockets of liquidity to either assume that risks or find strategies to mitigate those risks. But first, we have someone who has a network of pharmacy. That's probably not the first thing we think about when we think about infra. Rodolfo, could you explain a bit the high infra features that your business has and that has allowed you to benefit from Antin's support?
Of course. Well, I'm sure a lot of you are familiar with the differences between the model that we see in the Anglo-Saxon world, the drugstore model, versus the pharmacy within the national healthcare system model that is typical of continental Europe. Italy's specificity is that in 2017, a market liberalization happened, and the way I explain it is until 2017, only pharmacists could own a pharmacy. After 2017, the ownership was open up to investors. That's when, in 2018, I founded Hippocrates, together with my business partner Davide, and we are since the largest pharmacy network with over 500 pharmacies. So this model, pharmacies within the national healthcare system, what backs up this model is a strong regulatory environment. So to put things very simple, you cannot open a pharmacy in Italy. You can only buy an existing pharmacy and you get a lifetime license, first. Second, you cannot move the pharmacy where you want. At municipal level, each pharmacy has a monopoly area, and only that area is consistent with that license. Third, you can only buy prescription drugs in pharmacies in Italy. So if you mix that with the local area, in a certain area, only that pharmacy will serve prescriptions. Fourth, prices for prescription drugs and margins are defined by law. So you see that our model, the pharmacy model in Italy, is underpinned by a very strong regulatory framework. You match that with market trends. Many of you probably are familiar with the fact that Italy is the second oldest country in the world after Japan. Unfortunately, getting older, unfortunately, as we grow older, our visits to pharmacies increase. You are probably also familiar with the deficit that we have in terms of government and the pressure that from the National Healthcare Service perspective we need to face. We are closing down hospitals, especially proximity hospitals. The number of GPs is decreasing, also because of the demographic effect I was describing to you before. So what you are left with is this network of pharmacies that are really the first and foremost access to healthcare advice in the country. So you have a strong regulation and you have favorable market trends. What you get then is a very good visibility in terms of cash flow generation. First, sales. As you can imagine, the drug consumption is not correlated to a market cycle. It's correlated to the other trends I was describing to you before. We are a market, we are a sector where we have minimal CapEx requirements. We have a structural negative working capital requirement, so that you get a very high cash generative business. Essential service, strong regulation, favorable market trends, very good economics.
Laurent, perhaps as a future operator of a high-speed train network in France, can you elaborate on the infra-like characteristic of your business?
Yes, I think to some extent it is just like what Rodolfo explained, that it's about the regulatory framework. And it has just changed in France, as well as it has changed in Italy a few years ago, and it's about to change in a few other European countries with the new capacity management regulation that's now under trilogue in Brussels. So, because of the change of the regulatory framework, it's a new asset class that is now emerging in Europe. This was recognized by GIP when they invested in Italo NTV in Italy, and probably Rodolfo, you've taken the trains that they operate, and they are making nice margins on each of their tickets they sell, much better than Trenitalia. And Antin has recognized as well this investing in Proxima in France, and Kevin Speed has changed the landscape in France by pushing the authorities to go for long-term track access framework agreements, the way it was done in Italy and the way it's been done in Spain. So what are those track access framework agreements? They are allowed by EU regulation, and it means that as an operator, you get guaranteed access to some slots to enter some stations to get where the passengers are. And of course, there are slots and stations that are extremely profitable in high speed in Europe. The most profitable and the deepest market for high speed is Paris. A train ticket to Paris, when you pay 100 euro, and you pay 100 euro much too often, it's even more than that now, you pay 58 euros of EBITDA margin. This 58 goes 18 to SNCF Voyageurs, 40 to SNCF Réseau, and help to subsidize all the network everywhere else in France. It's very deep, very profitable. It's millions of travels every year. And this is now opened by the track access framework agreements that allow us, Kevin Speed, for example, to run one train an hour from Paris Nord to Lille, Paris Est to Strasbourg, or Paris Gare de Lyon to Lyon. So what you basically get is a real access to a deep and profitable network. And then there comes a second aspect that makes it a real infra-like asset, which is that the profit you can make is regulated by the track access charges regulation. So people tell you, oh, there are very high track access charges in France. Yes, they are very high because it's extremely profitable. Okay? But this is regulated. This is regulated by EU regulation that's been transcribed in French law and has been published by Autorité de Régulation des Transports, which is the Transport Regulation Authority in France, to say that it should, because EU law says it should remain sustainable for operator, it should leave you at least 12% EBITDA. And on top of this, it means that if you have two operators, and if you are the strongest operator, which we plan to be, and I'll explain why later, the 12% EBITDA is for SNCF Voyageur. You get more than that because you get all your efficiency difference to SNCF Voyageur. So this is published by RT in its opinion of 2023-008, February the 9th, 2023, and confirmed by SNCF Réseau in the letter to operators dated October the 1st, 2024. So this is very new. This is a new asset class, and this is infra-like because it's based on guaranteed revenues.
Thank you, Laurent. Very interesting. So you told us how you would protect, I would say, how your future business is going to be protected in terms of price, in terms of pricing, which is quite interesting. So Ben, how do you approach, I would say, the extreme high volatility, I would say, in the energy sector for your investment?
So this is a really fundamental issue for us at Statera. So the purpose of the company is to balance the grid in the UK, and UK power markets are volatile, and they're expected to become hugely more volatile in the future as the renewable assets are rolled out further. So it's a real paradox for us. How do we profit from this volatility whilst demonstrating these infrastructure-like characteristics? We were acquired in January by EQT, by their infrastructure fund, and that was a big part of the debate we had with EQT, was how can we increase our infrastructure-like characteristics whilst retaining full flexibility to benefit from the equity upside from that volatility. If we look across the technologies that we invest in, some of the gas peakers do have a capacity market contract. They're basically subsidized by government to be backup supply. So that is relatively straightforward, and we closed a debt facility with Natixis on one of these plants last week, which was great. For pump storage and green hydrogen, there are some emerging government contract for difference and cap and floor mechanisms which should be quite helpful. The most challenging one is really on the batteries. So we have a huge need to roll out large-scale batteries across the whole of Europe. In the UK, there is some very modest government support in the form of a capacity market. But from the equity investor perspective, for sure, they need to believe in this market long term. There needs to be an underlying belief. And that has been tested. In the last year, we've seen some massive downward volatility and some periods of relatively low margins. So it's been a very live issue for us. So our job in the company is to find creative ways to mitigate this. And an example of this is to really seek out a counterparty who's got a correlated relationship. So we kind of 4 or 5 years ago entered into an offtake agreement with Statkraft, one of Europe's biggest renewable generators, and they've been prepared to provide a floor at a cost. And that floor has evolved and grown and matured quite significantly over time. So that allows us to give lenders a very high level of comfort on the revenue through the cycle. So that was quite innovative at the time, and I think we'll need to see a lot more of that. There is an ask, I think, for lenders, which is to share that belief in the market, and that's an active area of discussion with the Natixis team today, actually, for our next batteries, is how can we take more of a view on the market itself. But it is hugely challenging given the level of volatility that we have. But our mission with EQT is to increase our levels of contracted revenues, allow us to lower to a high level, and benefit from that upside beyond.
Thank you very much, Ben. Christophe, you've been active in the EV charging space. Volatility of revenues, how do you manage that?
So the first thing is similar to Laurent. There's not, like in trains, there's not one EV charging market. So that's really the first thing everyone needs to have in mind. So you have home charging, destination charging, en route, so in hotels, offices. So all the markets are very, very similar, dissimilar characteristics. So that's really the thing I would like. I mean, it's probably clear for most people in the room, but that's crucially an important matter, based on the fact that a fast charger is 300 kilowatt and an home charger is 7 kilowatts. So it's very different in terms of where you are. So a fast charger needs a grid connection. So there are grid connection constraints to obtain. So it depends on one country to another how you can obtain. We can't see it yet in countries like France, but it will come more rapidly than what we think. And so that's really the first point. So EV fast charging is where we are. Then it's a matter of how do you assess and where you choose your geography. So recharge is an asset which is in Scandinavia. So everyone may have heard that penetration rate of electric vehicle is very high, but it's probably more than what you have in mind, because it's more than 90% of new registrations are electric vehicles, and the stock is more than 35% of overall vehicles are already electric. So, which is a good lab to start an investment as an infrastructure to assess the behavior of people. To give you an example of how infrastructure-like is fast charging in a country like Norway, the volumes on 50 kilowatt charger, which is, you can't even see some of them, and the chargers you have in Paris would be 7 kilowatt chargers on street. The volume on 50 kilowatt chargers are actually dropping on historical because they are not fast enough for public charging. So every customer actually expects to have fast charging, so at least 150 plus. So you have the grid connection, you need to meet demand, and then it's your overall assessment of what is the service of fast charging will represent on the overall market. So there are some public numbers. I won't be able to give some the private numbers on recharge, but if you go on the website of Fastnet, there are numbers. Some assessments are made by BCG and McKinsey about the volumes and the percentage of overall kilowatt hours which are going to be sold on the fast charging activities. So some of them assess that it will be more than 30%. I'll let you conclude and have your own views. So in terms of how do you tackle the volumes, it's also having some margin because it's a commercial business. It's a business which in the end sells kilowatt hours. The infra characteristic of fast charging was part of my introduction, saying once you've got the grid connection, it's extremely difficult for somebody else to actually claim the same grid connection because you're connected to the distribution network. So extremely difficult if you already have 10 megawatt of grid connection for anybody else to have the same connection across the road because it's there and there's no additional need. So it creates an absolute barrier to entry in that regard. On the rollout of electric vehicles, we need to form a view on several matters. So the first one is obviously the penetration rate of electric vehicles. The other one, which is the renewal rate of the fleet, which varies massively from one country to another. So as far as I remember, the highest renewal rate in Europe is, apologies if there are some Germans because it's a bit finger pointing, but it's Germany. They change their vehicles more often than anywhere else in Europe. Exactly. And then if you go in countries like Poland, like Greece, people will keep their vehicles up to 20 years. So this obviously has an aspect in terms of how the market will evolve over time and what it's looking like. So I'm hearing various things about the way electric vehicles are being sold today. So there is less vehicles being sold, but that's the overall car industry. But there are more electric vehicles and plug-in hybrids being sold than this year. So Tesla's volumes are still increasing. So it's more the car industry than the electric vehicles themselves. So it's still developing. Is it developing at the pace which was anticipated? No, there's a slowdown depending on certain projections, but then the sort of question is, which projection did you take into account yourselves? So are those who are made public, or do you make your own assumption, and having, you know, some, I would say, more cautious expectations in terms of what the revenues could look like in the future. So it's sort of a matter of assessing this and taking some buffers, taking some headroom in terms of the things we can be developed going forward. So that's really the way we are. And then I think it's been mentioned by quite a few people, even on the pharmacies. There's one thing, and sorry to be ironic, you can't have any grasp on, is the political aspect. So obviously, if you're investing in a business where 6 months before all politicians in Europe say, okay, no thermal vehicles post 2030, and the week after they're saying actually it's 2035. So this you need to take some buffer and headroom again, because like everyone in the room, never underestimate the political aspect.
Thank you very much, Christophe. So we've heard from Ben that you're looking for some type of contractual protection to mitigate. On your side, Christophe, it was more like to take a view on the market. That's basically what, and putting caution in place. On the rail mobility side, Laurent, how do you deal with that?
Just a quick comment on Christophe and energy prices that tend to change because of political reasons. I mean, there's a sudden fashion for drill, baby drill, that was not fashionable 2 days ago. So, just to say that it's a question that's been asked many times by lenders and investors, which is, oh, okay, it's a nice business plan, but you're operating a railway, you use a lot of energy. Okay, and so what happens if your energy gets more costly, like, you know, during it was in Ukraine war? And so basically what you have to understand is operating a railway is in fact operating an oil well. Why? Because on a railway ticket, you only have 5 euros out of 100 euro that's for energy. Because a railway is still over rail running, so it uses 6 times less energy than a car per passenger or a plane. So it's extremely energy efficient. So when you represent only 10% of the market of transport, out of a market that is so energy intensive compared to you, every time energy is more expensive, you can price up your tickets. You get pricing power that goes much faster than your costs. This is why SNCF has been extremely profitable in 2022. If you look, they had record profits. Why? Because petrol was so expensive. And so it's all about comparing. Doesn't depend so much how expensive energy is going to be. It's always going to be cheaper to run on a train. And so it's a little bit like investing in shale gas. You're indexed on the energy price. I know, so if you can't invest in shale gas for whatever reason, and you want to be indexed to that, you can invest in railway undertakings. So drill, baby, drill.
Thank you, Laurent. We started to talk about revenues. You touched based on costs. Christophe, you asked, yeah, you were saying that you need to take a view on the EV charging market to be able to get comfort. Another way to get comfort is to mitigate the cost side of things as well, operational, and how you manage the inflation. Do you look at pass-through mechanism? How do you handle that to try to protect your margin?
So once more, actually the power cost is a minor part of the overall cost. So that's as an introduction. So it's not that, I mean, it's important because everything is, but it's unlike you may think, it's not 90%. It's probably around 20 or so % of your overall cost, which is already quite significant. So that's the first thing. So then, in terms of hedging your prices, it's a difficult question, because if you hedge 100% of your prices and the power prices go down, you end up at, you know, a situation where you pay more your power than what you can sell it, because people will charge somewhere else. So we've been adopting various strategies. So rolling hedging, partial hedging, which so far all worked. But also there's an aspect which is extremely important in Scandinavia. That was the reason of our initial investment, or one of them, obviously, because there are numerous ones, is that the dynamic pricing and varying prices on the daytime, like countries in Sweden, is something common, even in your home. It's in the way you're actually purchasing the power. You have interruptible contract where you can choose at lunchtime to just stop all power devices for some of the Swedish contract you subscribe for yourself. So the views we've taken is, so although there's a sensitivity to power prices, it's a bit like, do anyone know in this room how much your tank of gas oil or petrol will cost you if you fill in your tank in 2 hours? You have no idea, right? You just pay the price which is there. And the other thing which is fundamental as far as fast charging is concerned, and that's an important behavioral aspect which I'll come to, is an emergency service. So the volumes are a minority part of the volumes, because most of the time electric vehicles are charged at home or in offices. So as a consequence, users will take fast charging because they need to go somewhere. So, and we've observed, and that's also one of the reasons fast chargers and ultra fast chargers are more used, is that people tend to stop more often and charge less. So, because in the way a battery is charging as of today, and that's a question of technological risk, we'll come back to this, is that a battery between 15 and 60% will charge extremely fast on a fast charger. So basically, this allows you to do 250 kilometers, and Scandinavians are extremely respective of the speed, so that's 2 hours of drive, basically, so that's one short break every 2 hours. And so we've observed, so the overall volumes on fast charger is increasing in terms of kilowatt hours sold, but the sessions per day are shorter also. So that's why it's really an emergency service, and so the market evolves, but they are very strong, as I say, these infradynamics around the need and the service you're providing in terms of, I need urgently to charge because I want to go as fast as possible for the point A to the point B, is extremely strong as the way we're actually observing the users' behaviors.
Thank you, Christophe. Comparable markets, comparable companies. This is a very interesting tool for bankers, for investors, I would say, to assess the interest of investment and the risk associated with it. Laurent, you mentioned, I would say, the Italian, experience with Italo in the Italian market. Can you elaborate on what can we learn, I would say, from this experience and others that you could find in Europe, for example, for this, I would say, new train, high-speed train operators market?
Thank you, Philippe, for the question, and I will talk under Rodolfo's supervision, who knows Italian market better than me, even though I know a little bit about high-speed rail. So when Italo and TV entered the market in Italy, they did have a framework agreement, but they entered on the principle that they would skim off the market as a luxury product. Montezemolo was from Ferrari, and it was all about leather seats, quality service, and so on and so on. And so they entered in 2011. They had a hard time because Trenitalia would not let them the central stations like Milano Centrale or Roma Termini and so on. But they ended up having the station, and they would still not fill the train. So after 3 years of hardship, they decided to go for cheaper tickets than the incumbent. And then they filled the trains, of course, because it's all about prices. And so once they filled the trains, the incumbent had empty trains, lower revenue, so they also had to lower the price of the tickets. And this ended up with the network, the railway network, lowering the track access charges as per EU law. And so now Trenitalia is profitable, and Italo is super profitable because they are making 10 to 12% more EBITDA margin than Trenitalia. And well, this boils down to a comparison to what happened to Italo, and this is when you enter, you have to be less expensive. This is also what happened in airlines. It's very difficult to build a new airline when the market opens and say, I'll be better quality, more expensive. Everybody stays with Air France and so on. So this is what happened. EasyJet and Ryanair and Wizz won the market, and they even now keep on giving a hard time to incumbents. And in Spain, this is what Wigo has done. They entered on a very low cost, very low price basis. And this is, today, Wigo in Spain in the competition ongoing as the best revenue per train set. Okay? So they're giving a very hard time to Renfe. So we said, okay, let's enter the market, but look at what happened in airline, look at what happened in Italy. Let's be low price, low cost. And so that's why we're an industrial team in the first place. It's about how to produce train cheaper with very high density train sets, more doors so that you lose less time at train stations, which is the basis of what has been done in airlines, as well as the basis of the way the Japanese operate. So you take, it's about, you know, high-speed rail is an old industry now. It's 40, 50 years old. So it's all about copy-paste the good ideas together and put them in action in France. This is what our business plan is about, and this is what we plan to do.
Thank you, Laurent, for this explanation. Clearly, we are talking about significant investments, and when we are talking about investment, we are talking about fundings. So, Rodolfo, what do you think are the most suitable, I would say, source of fundings, depending on the level of risk and the level of maturity of the project? What do you think, how do you see, I would say, the different sources to be organized, and do you see any trends? I would say some source of funding being used at the beginning and some other being used perhaps at a later stage. How do you see it?
Yeah, definitely. I think the company stage is really the factor in defining what you go out and look for. So to put things into perspective, coming back to the regulation I was mentioning to you before, we can only grow by acquisition. We acquire 100 pharmacies per year. You know, Italians don't work in August and December, so it means 10 pharmacies per month. It means we acquire 2 pharmacies per week. This means that we invest approximately 270, 280 million euros per year. We are like a mid to big mid-market private equity fund focused on pharmacies. You understand that capital is key, and optimizing the sources of capital for such a company is absolutely utmost. So when we started in 2018, before Antin, we chose to go for a case-by-case LBO. So I'm sure the audience is familiar. You have your pharmacy target, you create an SPV, you put debt, equity, a reverse merge, and you do that. Was very efficient at the beginning. We worked with local banks, great terms. Then after 110 acquisition, you realize you have created a monster of a financial structure, and you have 30 counterparties. So when we sit down with Antin after the acquisition, we ask ourselves how we can optimize this, what we can do. The problem was 2021. Remember, we started the company in 2018, so we didn't have enough track record, another element of the company stage, track record. How much track record do you have? We didn't have enough track record to go full-blown, we do an infra story, etc. And so 6 months into the story, we worked together also with you on a CapEx line. So we maintain these lines in place. We said we get more funding for this acquisition, for this massive acquisition effort. We bought ourselves the time until December 2022. At that moment, we decided to go with a comprehensive refinancing. Of course, many of you will remember December 2022, not a fantastic time, to go and issue that. But we managed to do almost 1 billion transaction. We managed to do this with infra counterparties, talking about the importance of having our name, this new infra-like asset, as you are calling it, into this panel under the radar of InfraDesk. And we managed to do that for 50% of refinancing, 50% of new pool of capital. And mentioning trends, this ability to have such a significant CapEx line, for me, really translated into a competitive advantage for us. Because at that time and during the last year, we were able, working with Natixis especially, but working with our, such a relationship bank, we were able to have the capital to invest. The other were left with no capital, and this proved to be essential to create a gap versus the second, third, and fourth player in the market. So this, I would say, is the different sources of capital depending on the different stages of our company development. How, building with our relationship with you, thanks to the work that the Anti team did, we managed to turn a challenge into a competitive advantage for our business.
Thank you. Ben, could you elaborate, I would say, on your views on the funding issue and what was your experience on this?
Yes, definitely some parallels with Rodolfo there, just around how we can scale the business really quickly in an efficient manner to bring the debt finance in and perhaps come back to the equity. So in 2018, we raised project finance against a 50 megawatt battery, which is a first in the UK. So the amount of time and effort that went into that was disproportionate, effectively. So that the next round was a portfolio facility for 350 megawatts, which was set up as a structure we can then fold assets into as they got land, planning, and grid. And the latest project we've done is a 750 megawatt, and we have a 1 gigawatt project next year. So it's really getting a mechanism that could just scale up, bring the banks on the journey with us. So having just closed debt facility last week, it's great to start the conversation about the next one. How can we optimize and improve that and bring people on the journey with us? So in our sector, it's all about really taking that market opportunity and scaling up quickly. From an equity perspective, there's often a bit of grant money available. So some of the projects we're looking at have got real sort of national significance, so particularly hydrogen grants to really sort of prove the concept out. But effectively, it's the belief that we need from our equity investors. So our founders got the business going with a bit of their own money. They brought in a mid-tier private equity investor, put 100 million in, and now with EQT, we have up to $1 billion of equity to really take us on the next stage of the journey. So it's really about how do we maintain that pace and accelerate building our track record.
Thank you very much, Ben. We discussed about revenues, we discussed about costs, sources of funding. What about the technological risk? How do you address it, Ben, if you want to start on that one?
Yeah, so for us, it's all about scale and the fact that the need for energy storage and flexibility is just immense across Europe as we build out the renewables, the solar and wind that we need to meet all of our targets. So I think the challenges are that we don't have much of a track record from suppliers. We have supply chains that are immature, fragmented. We don't have full EPC wrap. And so I think that first mover advantage is helpful. One of the things we've learned is that we should do as much as we can ourselves. So we develop that internal capability, so the engineering and the procurement, so to taking that on ourselves. The final aspect of it really in the battery sector in particular is the scaling up of the large-scale battery production coming out of China is just absolutely huge. We're seeing some fantastic cost reduction, the same as we've seen in the solar industry, but that does present some issues around the fact that your next plant is 30-40% cheaper, so certainly from a lender perspective. So keeping up with the technology, being aware of how it's going to continually modify and improve, and I think there are clearly some supply chain issues. The same as for electric vehicles. Are we happy to have Chinese manufacturing because we don't seem to really have much in Europe?
Absolutely. Talking about EVs, you started to touch base on that, Christophe, as well, on the technological side, both evolution on EVs and charging points. Could you tell us a bit more?
Yes, so indeed, there is implication. So apart from electrification itself, the obvious elephant in the room is hydrogen. You have to form a view on this. So how long is it going to be? So the reality is, just look at the offer in such cases. And it seems that at least the OEM today have given up on hydrogen quite significantly. So there's, the offer is fairly limited, simply because of the lack of underlying infrastructures. So we formed the view that electrification will be on track. The first time was 4 years ago and 3 years ago as far as grid service concerned. Even for trucks today, electrification seems to be well on its way. So that's the first aspect. So what is the demand? Then on the technological risk is how many kilowatt hours will be needed. Because in the end, you sell kilowatt hours and you need 20 kilowatt hours to drive 100 kilometers. So if there are more efficient batteries, and that's already the case today, because you have 800 volt batteries available now as opposed to 400 volt batteries. And guess what? It's good news. It's good news because they charge faster, so we can use our charger more. But the vehicles still need 22 kilowatt hours to drive 100 kilometers, so it's fantastic. So it seems to go in the right direction.
Thank you very much. A great round of applause, please. Thank you. We have a couple of minutes for questions as well, so don't hesitate to, again, raise your hands if you have any questions. I'm sure there's a lot to say more. So yes, please. Microphone is arriving. Don't hesitate to stand up if you can and tell us who you are. That would help.
Thank you. Eric McKeels from OMERS. I had a question for Rodolfo. To what extent can you also extract operational and commercial synergies, or is it a pure financial play?
So I think that the potential is extremely high and very tangible, and explain you why. We are COGS business, so meaning that if you look 100% of our sales, COGS is approximately 60%, 65% of that. As you can imagine, next year we want to do 1 billion in sales. If I'm able to extract, I'm able to be 10% better than the single pharmacy, then it's 6% EBITDA margin. It's that easy, okay? So it's all about hard cost synergies. All this in a market where the number of pharmacies is given, so every year you increase your bargaining power, right, vis-a-vis your suppliers, because every year you represent a bigger market share, both in terms of number of pharmacies and quality of pharmacies that you acquire, hopefully. And so the potential is extreme. That's actually what we've been focused on until now, is really to extract synergy from that. And to be honest, it's that easy as I explained to you. Every year we do a budget and we do better than that because really size matters. And so it's absolutely a key element of our value creation process that is really on top of that infra baseline that I tried to describe you before.
Any other questions? Well, thank you very much. A great applause to you. Thank you.